The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin, Jeong. The U.S. Fed delivered its first interest rate cut since December 2024, lowering the federal funds rate by a quarter percentage point to a range of 4 to 4.25%. Policymakers signaled that two more cuts could be on the table before year-end, citing a cooling labor market even as inflation remains above target. Markets reacted cautiously. Long-term Treasury yields actually moved higher, and the dollar saw mixed trading, underscoring how uncertain the outlook remains for rates, bonds, and currencies. So what does this mean for investors? How should we be thinking about U.S. Treasuries, the dollar, and the broader global fixed income markets? Well, to find out more, I'm joined by Kenneth, head of international fixed income at T. Rowe Price. Hi, Kenneth. Welcome to the show.
Thanks. Great to be on.
Thank you so much for joining us. Well, Kenneth, I want to start off by asking you, what was your take on the Fed's recent decision? Did they strike the right balance between inflation risk and labor market weakness?
Look, I think there was a couple of things that the market found interesting and drove the market reaction after that. The first was the votes in the committee meeting. I think people had expected to see more votes for a 50 basis point cut. In the end, there was only the one. And the market took that as being a little bit on the hawkish side, because they thought that maybe there was a possibility if the Fed, at least if they didn't cut 50 basis points this month, then maybe they might cut at 50 basis points at another meeting later this year. I think the other thing very interesting about the market reaction, it tells us that the market really had this, was highly expected. The market was already positioned for it ahead of time. It was already largely priced. And the market has evolved a lot in the last 5 or 10 years, and the Fed communication has evolved a lot. And so there used to be this assumption that, if the Fed's going to cut, well, then the bond market should rally afterwards. But now the Fed, they more or less tell us exactly what they're going to do ahead of time. So the market prices that in, it positions it for it, and then quite naturally, then you see us even as sort of a very small hawkish surprise within the market sells off afterward.
Right. Well, let's take a look at how markets have reacted. I mean, Treasury yields moved higher, especially in the 10-year and long end, suggesting markets are still cautious. So markets seem to push long end yields higher despite the cut. How do you interpret that move, and what does it tell us about investor sentiment?
Well, I think that it tells us that the markets are noticing that growth in the U.S. is still okay. We've had a number of data points recently that have showed that growth is still holding up pretty well. We look at things like the Atlanta Fed GDP now. It's a nowcast of GDP growth in the third quarter. That's still well over 3%. We had the Philadelphia Fed number out yesterday, which was quite strong. Initial claims also came back down again after the anomalous reading last week. So I think the market's seeing that actually growth in the U.S. is okay. So the Fed maybe not need to cut quite as much as the market has hoped for. The second thing is that inflation in the U.S. still remains quite high. And although the Fed is shifting its emphasis to be more concerned about the labor market than inflation, the inflation problem is still there in the background. We have core PCE running at 3%, and it's been above the Fed's target for 4 years now. And if the Fed's cutting into that environment, then I think it's quite natural for the longer end of the bond market to be a bit concerned.
Okay. Well, the Fed's move comes as the U.S. yield curve is, showing signs of steepening, with short-term rates anchored to policy expectations and long-end yields reflecting inflation risk. Where do you see U.S. Treasury yields heading from here then? Are we looking at more steepening, or could we see a rally in the belly of the curve?
Yes, we do expect the curve to steepen more, although I think it could shift from the steepening that we've seen so far this year. So far this year, most of the steepening has been driven by the very long end, as you pointed out, sort of like the 10s, 30s, or the 5s, 30s curve has steepened a lot. I think it's quite possible that we could see the 10-year part start to sell off more from here. Perhaps you could see 2s, 10s start to move. That's been quite stable recently. And then the reason is that now that the Fed started to cut, the market is going to start to think more forward about what is going to be the impact of those cuts on growth and inflation. And we're expecting Treasury yields to rise in both the short run and the longer run. Have a very soft target for somewhere around 4.5% by the end of this year, and in 2026, by the end of 2026, we're expecting Treasury yields to get back up to at least 5%, if not higher, at some point.
Well, then how does this shift in Fed policy affect your outlook for the US dollar as well, especially against major currencies? Do you see the US dollar plunging with more rate cuts in store?
So in the short run, the answer is no. We're actually more positive on the dollar. Many of our portfolios are modestly long dollars today. That's a very contrarian position. Most people in the market are negative on the dollars, and we do see positioning as relatively short. So just like with interest rates, the market knew that the Fed cut was coming, and so it positioned ahead of time, and we had some dollar depreciation into the Fed cut. And yet now that we're moving out of the Fed cut, there's room for the dollar to rise. With some stronger growth in the U.S., with the fiscal stimulus starting to impact the economy, I think it would be natural in order to see modest rises in the dollar into year end. 2026 could be a different story, particularly once Powell's gone. If we do see a more dovish FOMC, well, then that could put some downward pressure on the dollar at that point in time. But that's still good 5-6 months away from now.
Okay. Well, prior to the Fed's rate decision as well, some analysts had said that the bond market may deem the timing of the Fed cut too soon. Kenneth, is that what we're seeing now?
It does highlight how monetary policy in the U.S. has changed. As I noted, we have the Fed cutting interest rates with core inflation at 3% and with inflation being over their target for 4 years. That's very different than monetary policy has been in the past. It shows a much more aggressive form of monetary policy. It shows how they're putting more emphasis on the labor market versus inflation. And it shows that and they probably are managing monetary policy now towards a de facto inflation target of 2.5% to 3% rather than the official 2%. As opposed to whether it was too late or too soon. And I think the question more about was it really necessary for growth? And our view is that the labor market in the U.S. is actually in not that bad condition, although jobs growth has slowed, so has labor supply growth. So despite the fact that there haven't been that many new jobs created in the U.S. in the past 3 or 4 months, the unemployment rate is still quite low and it's only ticked up modestly. But the Fed is, as I mentioned, it's now much more concerned about the labor market than inflation. And that's a policy choice that they seem to have made.
Well, beyond the U.S., other central banks are at different stages as well. Some still tightening, others pausing or preparing to cut. Now, global bond markets, they're fragmented in response. So how do diverging central bank policies in Europe, Japan, emerging markets, shape opportunities in global fixed income?
Well, the one major central bank in the world that does have a very divergent monetary policy is the Bank of Japan. And we had heard from that, we had a couple of members of the committee that were voting for a hike, so that increases the probability we may see some hikes, another hike from them next month. And, we're expecting the BOJ to continue to push up short rates there. They're still very low given where inflation is. So they're still very negative real rates. And so that leads us to be overall underweight the Japanese duration, but then also to have a curve flattener on. So we're at the longer end. Most other central banks in the world are still running fairly loose monetary policy, if not cutting themselves. I think there perhaps is not as much divergence between central banks today as there used to be. And we're focusing more on places where we think the market is a bit uncertain, but where we think there could be some policy rate cuts coming up. The UK stands out as one where We're expecting fiscal policy there, tax rises later this year. It could then lead the Bank of England to cut rates. And so we think that makes gilts attractive versus other developed market governments.
Then where do you see the most attractive yields right now, Kenneth, across global bonds, considering both risk and return?
Well, we're focusing on a few different areas. First of all, in overweighting credit versus governments. By credit, I mean corporate bonds, both investment grade and high yield, and emerging market, and also securitized. Governments around the world are running very loose fiscal policy. Budget deficits are much larger than they've been historically. And on the other side, we're seeing credit is generally in a better shape. Many corporates are tending to deleverage. The amount of new issuance there is less. And so it makes credit quite attractive. So we think go with that trend, be long credit versus governments. Second of all, we're recommending exposure to inflation-linked bonds, notably in the U.S. buying TIPS, but also in other places such as Europe and Japan. And finally, overweighting emerging markets versus developed markets. Emerging markets, many of them are in much better shape than they used to be, both on a fundamental basis. Some of them have restructured their debt. Many of them are running better, more orthodox policies than they did in the past. And on the other side, the developed markets are not running as good policies as they used to, really. So it's overweight emerging markets versus developed markets. We think that trend is in the very early stages, and it could continue to go for several years.
Definitely. Well, then overall, Kenneth, how should investors position their portfolios after the Fed's latest cut?
So, keep duration low if you're a fixed income investor. And I said, focus on credit, versus governments. As long as you have a long time horizon, I'd say, keep your emphasis on higher risk assets. Central banks and governments are stoking the economy. They're stimulating the economy. That's generally good for high yield. It's good for emerging markets. It's good for equities. There's a lot of good news priced into the market right now. So it's always tough to know exactly what's going to happen over a 1 to 3 month time horizon. But I think, given a very strong economic outlook for the next 12 to 18 months, investors should go with that and don't be afraid of it. Just make sure that you're keeping the balance in your portfolio.
Right. Well, also, though, given the uncertainty surrounding weaker U.S. growth, sticky inflation, geopolitics, how do you balance risk and opportunity across sectors?
Well, our favorite sectors, I think we say you should have a barbell. And so go with some of the higher quality, short duration sectors. So if you're able to invest in some securitized credit areas like ABS, CLOs, high quality RMBS. This is very good way in order to earn a bit of extra yield in your portfolio, but without taking too much risk. On the other side, then you can balance that with some other areas that are where you get much higher yields, take a bit more risk, but also still keep the duration low. So things like loans are attractive. Also, emerging market corporates, I think, is another area that investors should be looking at.
Right. Some great insights from you there. Thank you so much, Kenneth, for joining me today.
Thank you for having me.
Thank you. That was Kenneth Archard, head of international fixed income at T. Rowe Price. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.